let's fast forward a little bit. Your Series A was 9 months ago, so all in, you're now 18 months into your company. And all things considered, it's going pretty great. In this lesson, we're now going to move forward and see what happens to your cap table when you raise your next round, the Series B. We're going to watch what changes happen with some of these important markers we've already learned about, such as bringing on new investors, adjusting the employee equity pool, changes to your valuation, and obviously, dilution. You ready? Let's do this. In the last 9 months since you raised your Series A, you used a good portion of that $3 million you raised to hire 30 new employees. You've now got salespeople, marketers, and product managers who've all started to build out their respective teams. In other words, Meetly starting to look like a real company. Now, in order to hire all those people, you made competitive compensation offers to them, which included a large number of stock options in the form of ISOs, or incentive stock options. And you were able to do that thanks to the expanded equity pool that you created with the Series A. Okay, you with me? Let's keep going. Furthermore, in the Series A, your investors set a valuation for your company, right? And from this valuation, they landed on a preferred share price. Then, separately after that, you got a 409A valuation done, which helped you establish a fair market value price for your common stock. This is also called the strike price or the exercise price. And remember, the strike price is the value of one share of common stock when you grant it to someone. In other words, it's the amount on a per share basis that your employees are going to pay when they choose to exercise their stock. Still making sense? All right, so let's now set the scene. In the last 9 months, you hired 30 people and you granted them stock options. Those stock options have a strike price of 50 cents per share, meaning those employees will have the option to buy shares at 50 cents. Okay, so right now, all of these new employees are roughly 9 months into their employment, right? So they're still within their first year, but in the next 3 months, something big and important is going to start happening to them. They'll be hitting their 1-year anniversary at your company. And remember, according to their vesting schedule, they're looking at a 1-year cliff. So the moment they hit 1 year, bam, they'll now be eligible to buy the first 25% of their shares at a strike price of 50 cents. Your employees are obviously feeling pretty good about this. The company's doing well, and those shares are looking like they're going to keep growing in value over time. Super exciting, and everyone's feeling optimistic. So what's next? Well, investor number 1 is excited too, and they're encouraging you to keep putting the pedal to the metal. They want you to take advantage of your traction and get Meetly in front of more people and start scaling your business. So, you can guess what that means. It's time for more funding. Welcome to your Series V. And this time, you're gonna up the ante and raise $10 million. So let's paint a picture of how this raise is gonna shape up. First, investor number 1 from your Series A wants to lead the next round. They're gonna put in an additional $5 million on a post-money valuation of, wait for it, $37.3 million. So at this point, your company's definitely growing in value. Okay, second, your safe investor, Carol, wants in on the Series B as well. She offers $500K. So you've raised $5.5 million already, which leaves you with $4.5 million to go. Luckily, your current investors know some people. They put you in touch with 2 other VC firms. We'll call them investor number 2 and investor number 3. These new relationships are a good match, and they help you fill out the rest of your Series B. Fast forward a few weeks and a little back and forth, a couple lawyer meetings, and voila, the term sheets are signed and the deal is done. Here's what the whole thing looks like. All in all, you've now got 4 major investors. You've got investor number 1 from the Series A, investor number 2 and 3 from the Series B, and of course, Carol from the seed round. Okay, Now that we know who's going to invest, we need to figure out the price they're going to pay for their shares. Again, remember what we learned in the Series A? This is complicated math, but after you do the calculations, the price comes out to roughly $1.83. Now, for your Series B, you're going to issue just under 5.5 million new preferred shares. So, all in all, your company now consists of the following shares that you've issued. You've got 9 million shares you issued to yourself and your co-founder when you incorporated. You've got 100,000 options that you granted to your advisor. Then you raised your Series A and issued 3,213,023 shares to investor number 1. At the Series A, you also converted Carol's safe and issued her 209,995 shares. And now, in your Series B, you've issued 5,466,271 new shares to all of your Series B investors. So, in total so far, you've issued 17,989,289 shares, just under 18 million. But remember, this is just the shares that you've issued. There are still some shares in the option pool, which we're going to get to shortly. Great! So let's look at the tally. Here's how many shares all your investors have right at this moment in time. Investor number 1 has just under 6 million shares. Investors number 2 and 3 have roughly 1.25 million each, and Carol has a total of a little over 480,000. But that's not all. Remember, up until now, your employee option pool had 1.5 million shares reserved, 100,000 of which have been granted to your advisor. But since you hired those 30 people, guess what? The option pool's almost empty. So, as a condition of the Series B, your investors require you to create an additional 1 million shares for your employee equity pool, so you keep hiring more employees and grow the company bigger. All right, let's now look at your cap table, adding in all the new ingredients that we just talked about. As you can see here, Carol's got 209,995 shares. Investor number 1 has roughly 3.2 million. Investors number 2 and 3 have roughly 1.2 million each. You have 4.95 million, and your co-founder has 4.05 million. The advisor you hired back in the day has 100,000, and you have a bunch of employees with different amounts of shares, depending on how much you granted to them. Now, the stuff all founders care about. Let's talk about dilution. Notice how you and your co-founder still have the same amount of shares that you always did, but the additional funding has continued to dilute your ownership. On day 1, you owned 55% of the company, and now, after the Series B, you own 32.45%. But remember, this is just a trade-off. In the early days, you owned 55% of basically nothing. Now, you own more than a quarter of a company that is valued at $37.3 million. Of course, at this point, these are all just gains on paper, right? But if the company was acquired tomorrow for that price, that's real money. And the future growth and value could increase your real gains, even if your ownership percentage declines. Of course, your ownership percentage may also matter for other reasons, like voting power and so on, but that's a discussion for another day. All right, safe to say, we've covered a lot of ground. You should seriously be proud of yourself. This is hard stuff, and by taking the time to understand it, you're setting yourself up for success on the road to building your business. That said, there's still some really important points we need to think about, such as what happens in a scenario where there's money that needs to be distributed back to investors? How's that supposed to work? Who gets what? And what can you do as a founder to protect yourself? Surprise, surprise, it's all tracked on the cap table.